Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So let's talk about Bank of Canada, right? Bank of Canada came out again, did it again. They held rates at 5%, which was expected. They didn't cut rates, which people are always guessing and anticipating. They didn't hike either. So I'm going to summarize a couple of things. What did Bank of Canada say? What any important lines that came out from Bank of Canada, so you have an idea where the path is when it comes to this rate cut expectation. So, um, a very interesting line from Bank of Canada saying that they're still concerned about risks to outlook for inflation, particularly the persistence in underlying inflation, basically hinting to you that inflation is still sticky, inflation is still there, and we got to continue to keep things tight until we see some good evidence. Bank of Canada also says wants to see further and sustained easing in core inflation before thinking about when it comes to any kind of rate cuts. They also say global economic growth slowed in the fourth quarter, but US remained surprisingly robust. In Canada, the economy grew in the fourth quarter by more than expected. There are now some signs that wage pressures may be easing. Year over year, 3 month measures of core inflation are in 3 to 3.5% range. Bank of Canada continues to expect inflation to remain close to 3% during the first half of this year before gradually easing, basically telling you, summarizing all here that, you know, the stickiness is still there, and that we won't see this decline in inflation very quickly, right? It'll take its time. In Macklum's opening statement, a couple of highlights here says that in the 6 weeks since our January decision, there have been no big surprises. We need to give higher rates more time to do their work. Again, telling you the pause is still going to be there for some time, very long pause, right? When we look at previous history, when it comes to pauses, like in 2008, 2007, and so on, it lasted about, almost, I believe, a year. So we could see the same thing there. It's still too early to consider lowering the policy interest rate. Future progress on inflation is expected to be gradual and uneven, and upside risk to inflation remain. We don't want to keep monetary policy this restrictive for longer than we have to, and basically talks about that before their April decision, we will also get new information on corporate pricing. Basically telling you that, hey, Loblaws, if you keep hiking your prices, grocery companies out there, if you keep hiking your prices, if, hey, Trudeau continues to hike those taxes, thus causes the groceries and the corporations out there to hike their prices, then guess what? Bank of Canada is going to look at that and say, okay, that's going to create some stickiness and elevation in inflation. So we're not cutting anytime soon, right? So even though this can be somewhat controlled, if the government chills out with the taxes, then sure, you could expect some easing. But there's also no control also on corporations doing what they want to do when it comes to cutting rates, right? So overall, the beginning statement when Macklem came out was basically reiterating the same thing over and over again, saying that we're keeping rates higher for longer, higher for longer, higher for longer. We're eventually going to cut, but inflation needs to show true evidence of it coming down before we do anything, right? And on top of that, you have the market now pricing in a 25% chance of a rate cut in April versus 40%. So before, markets were pricing in a 40% chance of a rate cut happening in April, but that has now changed to 25%, and it'll probably go lower as we approach April, right? Now, in the Q&A, what was very interesting from Macklem and also Rogers. Let's first talk about Macklem here. That Macklem says shelter price inflation is certainly weighing on our decisions. If we look beyond shelter, we're seeing underlying inflation persist. There are other underlying inflationary pressures beyond shelter. We're looking for further evidence of sustained downward pressure in underlying inflation. We will take our April decision in April. We'll most likely won't get to 2% inflation this year, thus keeping things tighter for longer. And it also, going back to the line, if we look beyond shelter, we're seeing underlying inflation persist, right? So basically telling you that, hey, um, inflation is still sticky there. We're still hawkish, and we think that rates are going to stay quite elevated for some time because, again, if you take out the shelter component and we'll go beyond that, inflation is still sticking around, right? So giving kind of that hawkish push during the Q&A session. What was also very interesting is that he also mentioned that there was a clear consensus not to cut rates now. He also said that there are some risks to housing market could re-accelerate. We've built some rebound into our projections, okay, saying that they expect some price move up, especially, the FOMO, the exuberance that will come in when the first rate cut comes in. All your realtors telling you buy housing, housing to the moon. Look at Dogecoin, look at Shiba Inu, look at Bitcoin. You missed that. You missed the stock market. Do you want to miss the real estate market too? No? So come on, buy, right? Which you can fully expect from many realtors to say. Um, but he says we are taking each decision one meeting at a time. We're not going to be lowering rates at the pace we raised them, right? So they increased rates quite quickly, and they said they're not going to be they're not going to be cutting them at that fast pace. Like I was saying, right? Like I was saying before that they want to go slow with the rate cuts, and we've seen this in history that they pause for some time, they cut, they do it slowly, they may even pause while they cut, and then if they start to see the shit's hitting the fan, then they're gonna do those aggressive rate cuts. So it's funny. Don't think, when people say rate cuts are great for the economy. Yes, depends where you are in the business cycle. We are coming off from the peak, and we're moving downwards in the business cycle to a point where we're contracting. And when when you go from a massive rate hike cycle to try to control the peak, and you keep rates higher for longer, and you keep the economy tight for longer, and then you have to cut rates and then aggressively cut rates, don't think that aggressive rate cuts is a good thing. It means that things are getting worse off and they got to do something about it. So that's why they said that we're not going to be lowering those rates at the pace that we raised them. And obviously, I would add there, they would only do that when things get really bad. So they also mentioned, the exuberance. That they could expect um, in the economy as well, expecting some tick up in inflation from the exuberance. Rogers mentioned that there does she did say that there does seem to be some exuberance in equities, so they're very highly aware of that. She also says commercial real estate risk spread more broadly than in U.S., right? So you could see it globally affect the markets, and yes, even Canada. I had someone the other day tell me that if you get someone on television from a bank was saying that, oh, the commercial property market for Canada is not so bad, even if you do get uh, you know the commercial property market to blow, it's going to be X percentage, which is very low for the banks out there when it comes to their balance sheet. Sure, that may be true, but in terms of nominal value And when you compare the nominal value of the commercial real estate, even if it happens to be 1% or 10% or even 10%, 1% of 10% or whatever the case may be, if that nominal value is huge and Canada's GDP is about only 2 trillion, let me just quickly confirm here. Canada GDP, it's about 1.988 trillion, right? USD. Then and you get commercial real estate that ends up being a big chunk, even if it's a small portfolio, a small percentage, it doesn't mean that it's necessarily we're out of the woods, because in nominal value, if that value ends up being in the billions, even 500 billion, right? You're not far off from damaging the economy, especially when you compare in comparison to Canadian GDP, right? So let's and I'll give you an example. Let's run some quick numbers, right? 500 billion, even if it's not such a big deal, right? Out of 1.988 trillion of GDP, that ends up being 25% of Canadian GDP. Okay, that's too big, Daniel. So let's do maybe 100 billion. What does that look like? That ends up being about 5% of the Canadian GDP. Let's go lower if you think that it's not going to be that big, right? Let's do 50 billion that gets affected in Canada. Again, that ends up being 2.5% of Canadian GDP. So it does in nominal value, even if you look at percentage, 10%, 5% of, let's say, the books of the banks or whatever, if that nominal value ends up being in the billions, 50 billion, right? 100 billion, being 5% of the Canada's GDP, that's a big hit, because Canada's GDP is not that big, right? In comparison to other countries out there, right? I think Texas GDP is equivalent to Canada's or more, right? Let's search this. Let's just search this, right? Let's do Texas GDP. Texas GDP was 2.3 trillion. Let's do Florida. Florida's GDP, 1.4 trillion, right? And we're talking about a whole country that's about 1.988, almost 2 trillion. And you've got states in the US that can match that or beat that, right? So, point is, even if that banker out there is out there talking about that, it's a small percentage. Billions are not a small percentage, especially when you compare comparison to the Canada's GDP, right? 5% hit, 10% hit, 20% hit, 25% hit. What do you think that's going to do to the job market? Small businesses out there, they're going to get affected. There's less funding, right? Unemployment rate goes up. Who's going to make the payments? People can't make payments. It all is connected. You just can't run away from it that fast, especially if the dominoes, end up continuing and piling on each other and it gets worse and worse. Right? So anyways, this was basically Bank of Canada. This is what they said. This is the summary. So it looks like they're continuing to keep things tight. They expect, just like in the US, probably inflation to uptick. They understand the exuberance that's going on. And, there's even talks about economists saying that maybe there might not be any rate cuts this year, especially if the economy is strong and inflation continues to be sticky. Then completely throw out the idea of any kind of rate cuts. That's a possibility. Imagine the shock on that. Imagine the shock on, if there's no rate cuts at all. Even if there is, and let's say it ends up being under-delivered, which has happened, like we saw recently with the Fed, and can happen, and has happened many times, right? They penciled in 3 rate cuts. Imagine they do 1, right? And they, just like what Bostic was saying, we're going to cut 1, not cut 1, but we're going to cut and then pause. He didn't say 1 or 2. He just said we're going to cut and then assess and pause. That's very likely, according to him, as of right now. So does that mean you're going to skip one of the meetings, not cut, and that leaves you to maybe two rate cuts? What's the case there, right? So the expectations that everyone in the markets and the realtors out there that, oh, once they cut, they're going to cut and cut and cut. Well, tell me, what is 25 basis points going to do? Is it really going to change the needle going from 5% to, 4.75%? It may help a bit, don't get me wrong, but it's not going to be a drastic change. It's still going to be up there, and the payments are still going to be high, right? And this is, I'm quoting the not the mortgage rates. This is the Bank of Canada's rates, right? So that's what I'm quoting there. So in terms of mortgages, it will be higher than that percentage, right? So very little change there. And again, if there's going to be a little cut and then a pause, and you have to renew, and it's gonna in your mortgage, you have to renew this end of this year or next year, whatever, middle of next year, whatever the case may be, and it hikes, and you're paying more, you'll be under a lot of stress for some time, especially because they're in pause mode, and there's a reason for it. There's a purpose for it, which people don't understand. That pause is to get the tightening, the rates, whatever they're doing in terms of QT, to push on inflation, to push it lower, to suffocate inflation. And how do you do that? By suffocating other people out there, to get them to spend less, to get the businesses to feel the pain, to bring the prices down there. In terms of fiscal from the government, well, the Bank of Canada and the central banks out there have no control. So they can't really do anything there. So if they start spending money like a drunken sailor, right? Trudeau, the government starts doing that, then guess what? The central bank, it's its own entity. They're going to keep rates higher for longer, and they're not going to cut that fast, that easily. So, anyways, these are just my opinions. This is my summary. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye bye.